Right, it looks like we are at time, so let's go ahead and get started today. My name is Chinna Chun and I'm with NACB, the Consultants Training Institute. Before we get started, I want to go over a few housekeeping items. First, if you have a AVW International subscription, you can obtain 1 hour CP credit by answering the poll questions throughout the webcast today. On the screen, you'll see the link to the subscription page if you do not have a subscription and you're interested in purchasing one. If you have any questions during the webcast today, please use the Q&A feature in Zoom. And that will be directed to the presenter. If you have any technical questions or questions about NACB or GACBA, please use the chat feature as well as be directed to me. Our technical editors for the show are Wolfgang Kniest, Andrew Newman, Pratik Shah, and Brian Jones as the advisor. Today we have the GACB news. We'll go over a couple of little items for you. And then we have Wolfgang Kniest, who is actually one of our technical editors, who will be joining us today, discussing business valuation based on company law regulations in Germany and Austria, insights into the outlook of the objectified business value. Right. Just to start us off today, just the GACB news that we had, we wanted to remind you that we do have some additional resources for you. ABW is one of the publications that provides you with current topics and information in the industry. We also have the Value Examiner, the Quick Read, to Journal of Forensic Investment Accounting, and also the European Business Valuation Magazine through EACBA. We do also have a business valuation articles library, which can also be accessed through the Economist. We'll try to bring you abreast to some of the information, keep you updated on some of the different topics that come up and that are published in this webcast and also in the 2-hour ABW webcast, the original version of it. All right, and with that, we do have Wolfgang Kniest, like I mentioned earlier, who will be joining us today. Wolfgang is the managing director. Let's see, I just lost the page. My apologies. Okay, Wolfgang Kniest is the managing director and co-founder of the European Association of Certified Evaluators and Analysts, EACBA, the European chapter of GACBA. EACBA is the largest business valuation association in Europe with more than 17 years of experience in training, certifying, and supporting the business valuation profession. EACB has more than 1,000 members from over 20 countries. Wolfgang has a cross-sector experience in the analysis and valuation of listed and non-listed national and international companies. As an independent consultant for the Certified Valuation Analyst, Wolfgang Kniest has more than 20 years of consulting in business analyst and valuation. He has many years of teaching experience in business valuation at the University of Applied Sciences in Erfurt and Frankfurt School of Finance and Management. Wolfgang also teaches and develops seminars and webinars, including the current updates and valuation, financial modeling, business value industry standards, and advanced topics related to business valuation, and is one of the main instructors of the Certified Valuation Analyst CBA training classes. Wolfgang is a member of NACBA's Valuation Counseling Board. He is the chief editor of the quarterly published business valuation journal, the Vortex. I'm sorry, Wolfgang, since 2005, and European Business Valuation Magazine, EBVM in English, since 2022. He is a co-author of the book Hanselmann, Kniest Business Valuation Practical Cases with Solutions, nearly 200 exercises. Yeah, and with that, I'm going to turn the time over to Wolfgang.
Yeah, thank you, Chanda, for this kind introduction. Yeah, thank you for sharing our today's show. Some weeks ago, I was invited to the Czech Republic, giving a speech on the objectified business value in Germany, and I recognized that for some reasons, also evaluators outside Germany and Austria are interested in learning a little bit about a standard of value, which is definitely not a worldwide used standard of value. But it's very important in Germany and Austria, as I said. I will give you a short overview today, what is behind these standard and values, and also try to compare it with the market value, for example, which is very often used worldwide. Yeah, let's start. Business valuation based on company law regulations in Germany and Austria. Insights into, so what is right now and outlook on, which means in Germany and Austria, both business valuation standards are under construction right now. There is no official version of a new draft, but there are some rumors, and I will guide you a little bit also through these rumors. So let's have a look here. Okay, my disclaimer. That's me. And these are the 4 points I would like to go through today. Short overview. Yeah, first of all is a starting point, and then a short overview of the standards, and then we would dive into the concept of the objectified business value. What is behind? What are the assumptions we have to use in Germany and Austria? Germany and Austria is not one by one the same. It's similar, but there are some differences as well. At the end, I would like to compare the objectified value with the market value concept, and then summarizing some outlooks to the potential exposure drafts which might be come out during this year. Yeah, starting with the purposes. These purposes are not different to the rest of the world. 1 second, I need to bring this. Yeah, okay. Maybe I will start with a question to the group. Have any of you ever been involved with valuations carried out in Germany or Austria? You can write in the chat book yes or no. It would be interesting for me, especially from all attendees outside Austria and Germany. So you can use the chat box and write yes or no if you have been involved in valuations carried out in Germany. Yes, yes, no, no, no. Yes, Penziri. Okay, I believe most of you do not have. Hari from Finland. Okay, so the purposes are the same as all over the world, besides M&A and accounting purposes. Especially the legal purposes in Germany and Austria have driven the assumptions, which I explain later, on this objectified value. But the objectified value itself is used for many purposes as long as there are other standards in place. For example, if you perform a fair value under IFRS, you are completely with IFRS rules, and the objectified value will not take place in these accounting valuation. But for all, especially for all legal valuation issues, tax-based valuation, and also the corporate law regulations like squeeze outs and domination and profit and loss transfer agreements and merger valuations, the objectified value is in place. When I started learning about business valuation many years ago, I recognized that there are 2 fundamental starting directions when talking about business valuation, and this is for me one of the reasons why this objectified value concept is a little bit different to the market value concept. Though we have this concept that value is a hypothetical market price. Yeah, a lot of screenshots from Wikipedia behind, Chicago School of Finance, Law of One Price, all these neoclassic economic theory behind. The value is the price of the functioning market. Missing prices should be approximately as close to the market as possible. We call it also value in exchange. And on the other hand, and that's where at the very end also this objectified value concept is based on, is decision theory. So value is very subjective and is based on an individual utility. So this is a starting point. We call it today in some areas value in use. And you might know that there are differences between value in use and value in exchange. So starting with these decision theoretical understanding, there are at the very beginning there are two very important value concepts, standard of values, and we call it in Germany and Austria subjective values. It's similar to synergistic value, strategic value for a buyer, or investment value for a seller. So this is the international wording for these subjective values. And so it's a maximum price for a buyer. It's a marginal price for a buyer from an economical point of view, as well as a minimum price for a seller from an economical point of view. And if there is a scope of agreement and they negotiate, they will come up at the very end with an agreement with a price. If not, they should stop the deal. So this is the fundament which is born in Germany, Austria, the last century, I think so 1960 around. And starting with these subjective values, the practitioners early 1970 realized that yes, there are many purposes, for example, in the M&A field, where it is totally clear to if you advise a seller or a buyer to deal internally with these subjective values and to work on a strategy how to convince the buyer to pay more than, from a perspective of a seller, to pay more than the minimum price, and also from the perspective of the seller to pay less than the maximum price. But there are a lot of purposes, especially in the legal field, where these subject values are not, at the very end, are not as helpful. And that was the reason why end of 1960, early 1970, the practitioners developed this concept of objectified value in Germany and Austria. Let's have a look at the standards. This is a page only with German standards, Q&As, technical notes, practical notes. The most important standard is here, number 1, IDWS1. It's in the actual version from 2008. It's called Principles for the Performance of Business Valuation in the official English translation. This is a core standard. There are some additional standards for different purposes. There are standards for intangible assets, There is a special standard for fairness opinion, preparation of fairness opinion, also a special application standard of real estate valuation, special topic on family and inheritance law. But these standards are more how to apply the general rules and maybe set some different rules for different purposes. Some notes on accounting evaluation, and here some practical notes on how to apply the general standard for small and mid-sized enterprises, for example. How to deal with the plausibility check of business plans, and how to deal with distressed company evaluation. This is the most actual practical note from 2023. Some Q&As also, so the Russian and Ukraine topic. So this is the German world. And we will talk today about these IDWS1. The IDW is the Institute of Public Auditors in Germany. It's a privately run, not-for-profit organization. And the members are both individual CPAs and audit firms. In Austria, there is a standard called KFS BW1. It's from 2014, Professional Guidelines for the Valuation of Business. And the publisher is the Chamber of Chartered Accountants and Tax Consultants in Austria. So this is, from a legal perspective, a little bit different to Germany, but even if this is a private, not-for-profit organization, the rules are so established in the whole business valuation community, in court, by lawyers. So the application is, to be honest, a must in Germany. Some different recommendations compared to Germany in Austria. They have some detailed recommendations on some special topics like DLOM, debt beta, how to deal with terminal value issues. Also, simplified estimates on value, which is a calculated value engagement, insolvency risk, and some details on the risk-free rate and market risk premium, as well as the liquidation value. These calculation engagement, which is possible in Austria, compared to Germany, there are no rules so far allowing more or less simplified engagement besides the conclusion of value in IDWS1. There is a discussion. Maybe though in Germany the rumors are in this way that there could be a three-part division, like, for example, in Canada. In Canada, we have the conclusion of value, we have an estimation of value, and the calculation of value with a decreasing degree of commitment. And it could happen that this will also include it in the new updated IDWS1 standard, but it is still not in place. One question: does IDW and KFSBV follow IVSC standards? No, they have their own content. So it is not forbidden to use international valuation standards in Germany, but then you have to describe. You will not be able to say I have prepared a fully fledged IDW as one objectified value, and only referencing to international valuation standards. And you will see why, because the standard of value, especially, it's not only a name. You will now see how detailed are the assumptions and the standardization of the assumptions behind. And I don't see any conflicts. I don't see any conflicts between IDW as one and international valuation standards, because for me, international valuation standards are much broader. Yeah, and IDW and the Austrian standards are much more detailed in some aspects. Yeah, but on the other hand, if you perform a international a market value valuation under international valuation standards, you will see that there is no standard of value called market value in Germany so far. In Austria as well so far. So you cannot provide a market value in the understanding of the international valuation standards, which are in line with the German and Austrian standards so far. You can try to apply the rules in Germany and Austria to come up with a value which is more or less equal to a market value under the international valuation standards, but there are some topics, size premium and discounts and premiums, and I will show you later, which are used differently in Germany and Austria than in the international field. Okay, but let's have a look first. General outline, and then we dive deeper into some of the topics, not everything, but some of them. So you see Germany, 180 paragraphs, 36 pages, very detailed, a little bit smaller, 24 pages, 156 paragraphs in Austria. This is only the general outline, but you see here, if you look at this, future cash flows, capitalization of future cash flows, valuation methods, there is no, on this level of outline, there is no hint to multiples, to the market approach. And I will come back later to this. In Austria, you see here is the income approach, and on the same level, the plausibility assessment with multipliers. Some special features, startup valuation, not-for-profit valuation. This is of minor interest today. And a very small section on documentation and reporting. It's, for example, compared to the international valuation standards. Much more details, not differently, fundamentally, but more detailed in the international valuation standards than in both standards here in Austria and Germany. The relevance of the stock market prices, especially for these squeeze-out valuations, and that's the reason why it is placed here in Germany. There are German court decisions from the federal Supreme Courts saying that for these, for example, squeeze-out cases, there is a floor minimum value, and this is an average stock price of these companies. It's a 3 months average, which has to be used as a minimum compensation in these squeeze-outs. So, general outline, a little bit more detailed, the fundamental principles. Yes, valuation date principle. Then a lot of how to determine cash flows and capitalization rates for the operational assets, non-operating assets. Yeah, very similar in Austria. And if you go through these topics, you will see that there is a lot of details on income approach. And I will show you the definition of the objectified value in a second, but the definition is the reason why income approach is mandatory in both countries for applying the objectified value. Liquidation value from an economic point of view is a floor value. Market approach is in both countries only a plausibility check. So you will see it is not allowed to perform an objectified value only with a market approach. You have to use the income approach, and you will see it because in the definition of these standard of values, they have fixed the valuation approach. It's the only standard of value worldwide I'm aware of where the valuation approach is fixed in the definition of the standard of value. In Germany, there is a can be used. So far, this I'm pretty sure that this will be changed in the new draft version. In Austria, this is a must. This plausibility check. But we are talking about legal valuations under this IDWS1 framework, for example, in a fairness opinion in Germany, and that's one of the reasons why there is another standard in Germany, IDWS8 for fairness opinion. Market approach, income approach, everything is on the same level, and everything will be calculated to parallel to assess the adequacy of an offer. Cost approach of very minor use, only for very special topics like not-for-profit companies, for example. And in Germany, there are some cases just at net asset values for real estate companies and holding companies, for example. But it's, in controversy as well. So let's come to some technical points before we start with the definition of objectified value. As I said, the income approach is mandatory, and the next question would be how. In Germany and Austria, or especially in Germany, we are very much focused on the equity methods. We also are allowed to use enterprise value methods, DCF WACC, APV, total cash flow WACC. So everything is covered in the standard from a technical point of view, but especially for all these legal valuations, for squeeze out, but also for tax valuations, the practitioners use flow to equity. They use flow to equity. Let's call it a German way of flow to equity. It's a more or less a dividend discount model in the first phase, and then a flow to equity model in the terminal value. And also this has a reason, and the reason will come a little bit later. It's because of the personal income tax, but this is a very, very special German point. For valuation for tax purposes in Germany and Austria, all three approaches don't have to be considered. Normally you are using, so you have to use the income approach, and in 99% of all valuations, there will be a plausibility check with a market approach as well. So normally you see two valuation approaches in Germany: income approach and market approach. From a technical point of view, we are very much DCF driven. So we look in the future, we try to give our best to capture the expected cash flows. In Austria, many evaluators use such three-stage models with convergence phases. In Germany, you see this also. Two-stage models are still dominating, maybe 5-year plus terminal value, or sometimes 10 years, 15 years plus terminal value. There are some detailed rules in the standards on the terminal value topic. For example, in Austria, in the standard is written down that you have to use the value driver model from McKinsey, you already know. So you have to, from a mathematical point of view, you have to connect the future terminal value return and the growth rate with your retention. They explicitly reference to this value driver model. In Germany, it's a little bit different. It's quite similar, but a little bit different. They are writing that the operational growth in these terminal value indefinitely lifetime world, the operating growth should be without any effect on the value. So which means that the internal rate of return of all future operating growth investments in these terminal value phase, this rate of return needs to equal the cost of capital. And then is the second growth, it's inflation growth, and yes. So there's a split between inflation growth and operating growth in Germany. And in Austria, they only speak about growth rates. Could be at the very end, could be inflation and operating or real growth. And you have to determine a return on new invested capital, and the guideline for most of the companies is that as a reference point, these return on new invested capital equals cost of capital in this indefinite lifetime world is a very plausible assumption for most of the companies. So what is the objectified value in detail? And how we come up with this objectified value? As I told, in 1960, the practitioners were very much forced by the theoretical community that value is very subjective, these decision theory thinking. And the practitioner said, yes, this might be true from a theoretical point of view, but we need something for these legal purposes. So where we have to come up with one number. And this was the time where this function theory is born in Germany. So if you perform a valuation in Germany under these IDW as one rules, you have to specify your function as the evaluator. You could be advisor, but if you take the advisor position, you must calculate a subjective value, a value for the owner, a value for the buyer. For this objectified value, you must be acting in the function of a neutral assessor or neutral valuer. And then we have this arbitration value. This is, as an arbitrator, this would be the function. In Austria, it's the other way around. You start with a standard of value, and the function follows the standard of value. In most of the cases, if you perform an objectified business value, you will also act as a neutral expert, and this is quite similar to Germany. In Germany, if you perform an objectified business value, you have to act. It's a must. You have to act as a neutral assessor. Okay, but what is the objectified value? And that's a definition in Germany and Austria. Yeah, let's have a look at some of these sentences. An objectified business value is an intersubjectively verifiable, so this value of future earnings. And here, future earnings it's not the best translation. It's future cash flows. From the viewpoint of the shareholder, this arises if the business is continued on the basis of the current business plan. Continued on the basis of the current business plan. This is quite different to highest and best use, for example, in the international market value environment. So continue on the basis of the current business plan with all realistic future expectations in the context of market opportunities, market risk. So there could be some changes in the business plans from the current model, but it must be based on the documentation in the current business plan. This is very, very important. Here's some additional ads for the income tax, personal income tax. I will come to this a little bit later, but very shortly only. Important is these intersubjectively verifiable. What this means, I will come back to this on the next slide. Future earnings means income approach. So you have to apply an income approach. And this is, the second sentence is on the, how the future could be captured or could be changed in relation to the actual business. In Austria, quite similar, not the same, but quite similar. Objectified business value, standardized assumptions, which is intersubjectively verifiable. It's another phrase of the same meaning. Standardized assumption and using an income approach. It is assumed that the business will continue to be managed on the basis of the existing strategy. It's quite similar to current business plan and takes into account all realistic future expectations with respect to market opportunities, risk, and so this is identically. Here's current business plan and here's existing strategy. This could be different in one or the other case. In Austria, it's very important. There is very often the note, if there is a legal requirement, if there are tax laws or something else, or legal or court decisions which require something, then you could leave these, for example, these standardized assumptions which are in place for the normal objectified value. What is standardization and typifying or typecasting and objectifying? If you start with this subjective thing, so this subjective valuation, very often you cannot perform a valuation for one individual person, for one individual buyer or seller. You have to make a valuation from the perspective of multiple persons. You don't know individual factors if you have 1,000 or 1 million minority shareholders. So you have to set typified typecasting assumptions. This is one area. The other one is limitation of individual valuation factors. This definition of existing business strategy as a basis, this is such a standardization, standardized management factors, and we will come to this cost of capital. We are very, very much focused on the CAPM and CAPM only in this objectified value. And there is another subjective element. This is our professional judgment as valuators, and these should also be limited with objectifying the professional judgment. So you have to write down all the definitions must be verifiable, the projections and the parameters, everything must be written down in the report to make it possible for a third party to understand why you have used your professional judgment in this way. So summarizing everything together, from a standard of value perspective, which is quite similar to the rest of the world, is these value in use concept, value for the owner, investment value, subjective value. This is quite similar. Then we have these equitable value in the international valuation standards, for example, or the legal fair value in the US. This is quite similar to that, what we call arbitration value, and liquidation value is the same worldwide. Where we have some challenges in market value, value in exchange, and our objectified value, because our objectified business value is a value in use concept. And the challenge will appear if you talk about, for example, degree of discount for lack of marketability. Because discount of lack of marketability is definitely a concept which is relevant for value in exchanges, but maybe less relevant or no relevant with value in use. In the new revised standard in Austria, it is in discussion to add a market value concept beside the objectified value, and this will not happen in Germany. So it could be this year, end of this year, beginning next year, that in Austria we have a market value, standard of value beside the objectified value, but this will not happen in Germany, I'm sure. Another thing which could happen, that we will have some definitions for a typified subjective value for some typified assumptions behind these theoretical subjective value for buyers and owners. So, but now let's have a look a little bit deeper in these two objectified values in Germany and Austria. What are these assumptions behind business strategy? And this is very close related to the definition. Yeah. So its valuation is based on the earnings power at the valuation date. Yes, it can include changes, but these changes must already be initiated at the valuation date. So you need a form of concretization of strategy changes. So it must be more than only an idea of a controller, what could happen, or what could we make in the future. Yeah. So it must be, those changes in the future must be documented so far. And a concrete application of these is the discussion what kind of synergies are allowed in the objectified business value. And in Germany, we call it pseudo synergies. In Austria, we call it realized synergy effects. Those effects are allowed to be included in a business plan for an objectified business value. These pseudo synergy effects could be utilization of economic of scales, improved cash management, cost reductions through consolidation of parts of the company, HRs, for example. So everybody's synergies are allowed. And there is, again, these requirements, they have to be initiated or documented in the business plan. And this is, yeah, it's a very strong requirement, and it can also be used by the company itself. If you have no documentation of synergies, it is not in your objectified business value business plan. This is also an area where we will have changes in the future. Maybe I suspect that this section will be reformulated to be more open. Maybe they reduce the requirement of this documentation, and it could be that the direction of this synergy debate would be in this similar direction, like in the market value discussion, where you discuss about market participant synergies. So there could be a harmonization with the international discussion on synergies. For the business plan itself, yes, the numerator has to be expected values of future cash flows. So no best case, no worst case, expected values. And this is, from a practitioner's point of view, this is very hard. In Germany, there is a strong reference to the management plan so far. In Austria, they split between managing planning and planning consistent with the expectations. So you see in Austria, you see much more that the valuator creates based on the existing business plan, builds his own business plan for valuation, doing some adjustments. The reason why in both standards there is the numerator is fixed as the expected value, the reason is that the denominator is also fixed with a cap M. And if you are forced to use cap M only, you need expected values in the cash flows. So if you are not allowed to add specific company risk premiums, etc., to your discount rate to catch a business plan which is far away from expected value, then you are leaving the cap M, and you will see a little bit later in some minutes that the discount rate is also fixed with a cap M. And then if you fix the discount rate with the cap M only, then it is consequent to write that the business plan has to be an expected value. And yeah, to come up with an expected value, we have detailed hints how to make plausibility checks. There is an interesting practical note here. Maybe this is a useful scheme also outside Germany to describe plausibility checks of business plans, mathematically accuracy and formal plausibility, material internal plausibility. Does the business plan fits to the explanation, to the business analysis of the company itself? Material external plausibility. Does the business plan fits also to your own market analysis, to your benchmarking? And also this definition is, I think, useful. Plausibility is given if the underlying assumptions and resulting planning figures are comprehensible, consistent, and free of contradictions, and in accordance with the findings of the market and competition analysis, the company and business analysis, and the analysis of the financial performance of the company in the past. I think this is a useful definition and also a useful structure, and you find in the newer business valuation reports, you will find in Germany exactly these chapters of plausibility checks. Okay. Management factors. Also standardized assumptions behind in both countries. Usually, it is assumed that the management will be retained or it will be replaced equivalent in the future if there is a change of the management. This is the usual assumption in both countries, but be careful if you have a very, very small owner management business. You must be very careful. And then in Germany and Austria comes a concept into place. We call it, we have to value only the transferable earnings power if you have such very key person related cash flows. So you have to look in the future. You have to make assumptions. What would be the transferable sales, the transferable cash flow to a potential buyer? This is quite similar to what we have in the international field if we discuss personal goodwill and business goodwill. Only the business goodwill portion is transferable, and cash flows which are related to the personal goodwill cannot be part of a market value. This is quite similar to what happened in a market value calculation. Financing and distribution assumptions. This is, as I said, in Germany, especially in Germany, we are very often use flow to equity. And if you calculate flow to equity, you have to have a complete balance sheet. You have to set assumptions on dividends. You have to plan your debt, or if the company plans the debt, you have to make some plausibility checks for the future debt. Yeah, and you have to do these splits in so operating business plan is similar as in the rest of the world, but then we have to, in addition to the operating business plan, we need to take care on assumptions, on plausible assumptions on the distribution or on dividends and the debt development. There are some hints for the terminal value. Again, in Austria, in the terminal value, the expected returns, growth, and reinvestment policy must be consistent. It's similar in Germany. It must be also consistent. Here we have in Germany some additional hints, and the reason behind this is the personal income tax. And I don't dive into personal income tax now, because this is definitely the most country-specific topic in Germany, only in Germany, because in Austria there is a rule. Yes, it is from a theoretical point of view, it's correct to take into account individual investors' personal income tax, but you can ignore it for simplicity reasons. So in Austria, no personal income tax. In Germany, for these very important law-driven corporate law and contractual requirement valuation, for these squeeze-out valuations, and only for these cases, we have to take into account the personal income tax. And this looks very complicated. It is complicated, but yeah. I will not dive into this today, but at the very end, if you have a cash flow and a discount rate, and you would include investors' tax, you have to split everything into dividends and capital gains. And the idea behind is not born in Germany. This is a concept developed by Michael Brennan in the US in 1970. Yes, the Germans used this with assumptions, and you have to make assumptions to split the flow to equity in dividends and in capital gains. You have to make assumptions on the personal income tax rate. And this is such a standardization of an assumption. We assume if you apply these in a squeeze-out valuation, you ignore the actual individual investor tax situation of these 1,000 or 2,000 minority shareholders, the assumption is that the shareholder is an individual person liable to unlimited domestic German tax. That's such a standardized assumption behind the objectified value. But to be honest, this is definitely the most country-specific part and only relevant for these shareholder, for example, squeeze-out valuations. CAPM, as I said, CAPM only. The risk premium have to be derived from a capital market model, capital market pricing model, CAPM or tax CAPM, though there is no room for specific company risk premiums. So all these risks, which all over the world are captured in size premium, specific company risk premiums, the German valuator have to take into account all these risks in the cash flows. And that's hard. In Austria, it's quite similar, but they have opened it up that it is also possible to use methods for the cost of capital, which are commonly used and accepted. That's the question, what is this? What is this? So, our cost of equity, risk-free rate in Germany based on the whole complete yield curve, very detailed determination is called Svensson method. In Austria, they use for euro cash flows the German 30 years government bond. Equity risk premium, this is very much driven since some years from this implied equity risk premium discussion. You know, implied future-looking derivation of total market risk, expected market risk compared to the historical studies. And there are only 2 countries in the world where the standard setters, or I'm aware of, where the standard setters recommend ranges of ERPs. For example, in Germany, they checking these ranges each month. So now since 2019, there is a range for the equity risk premium from 6 to 8% in a world without income tax, which is relevant for most of the valuations. So for example, in January 2024, now we have a risk-free rate in Germany of 2.5, and many evaluators use 7.25 as an equity risk premium. But this range is provided by the standard setter. In Austria, it's not a range so far, it is a technique. So you have to determine you have to determine your own expectation of a total market return. And then you have to deduct your own, these 30 years German government bond interest rate, and then you have calculated your own equity risk premium. Okay, and now we come to the, to this point, discounts and premiums. And now you see that apart from the non-use of size premiums or specific company risk premiums, this is for me the most important distinguishing to a market value perspective. In Germany and Austria, the objectified value of a share is a pro rata value of the total value. So if you have a minority share of 20%, it's 20% from 100. 100 is the objectified value of the company, and 20% of the company is 20% of the total objectified value. And this fits perfectly to these legal compensations for minority shareholders, for example. For other purposes, like tax purposes, where we also have to deal with market values in Germany, this is quite difficult to get a good projection for a minority value if you are still looking at these 100% objectified value of the company. Okay, in the discount for lack of marketability, similar here, you see there is no discount for lack of marketability with the objectified value as a value in use concept. If you are talking about market values for tax purposes in Germany, yes, it could be a topic, but then you would leave the concept of the objectified value and you have to defend it. Similar in Austria. Okay, so 1 minute. This is nothing new. Some nice pictures from my colleague Klaus Rabel. Comparison, market value, objectified value, subjective value. Here are our subjective value in uses. Here is our market value, hypothetical willing buyer, willing seller, market participant. It's a value in exchange concept, is a value in holder concept, our business value. And again, this is nothing new. It's another way of presenting objectified value on the blue line here and the green line, market value, value in use, value in exchange, different. In a market value perspective, the perspective is a market participant. In our objectified business value, it is not 100% clear for me who is the assumed valuation subject behind everything. Income approach dominating in Germany and Austria, market approach, income approach for the market value worldwide. Existing use, business value, objectified business value, and the highest and best use premise in the market value concept. This is definitely a difference. The other standardizations are very similar. Next big issue, discounts and premiums. Very difficult, very great difference between objectified value and market value. And last but not least, the summary of the outlook, what might be happened. Plausibility checks strengthen the focus on the market side plausibility. Much more market-driven information, external information will be much more important in the future. I assume these are all rumors, only rumors. Separation of business plan versus business plan, which the expert has based the valuation on. Cost of capital, as long so far, it is very much driven by the actual debt structure of the company. They will open it up a little bit in the direction of market value with these peer group capital structures. And they will, in Germany, significantly deepening the content of market approach. But the hierarchy that income approach is before market approach, this will definitely remain. So it is not on the same level as internationally market income cost approach. It is a hierarchy that income approach is of prior use compared to the market approach. And this is in Germany, and this will also stay in Austria for the objectified value. And as I said, my last word today, market value, there is a huge chance that in Austria they will add these market value standard of value in the Austrian standards as well. So sorry for running a little bit out of time. I tried to give you a short overview about the content. You can, if you would like to get these English translation, the official English translation of the standards, you have to get in contact with the IDW in Germany or the KSW in Austria. It is not expensive, maybe 20 euros or so, but they sell the standards, so I'm not allowed to share it.
Thank you, Wolfgang.
Okay,
So is that it?
Sorry for the delay. Hope you get some fresh insights from Germany and Austria. And I also hope that you will never have to perform a valuation with personal income tax. But maybe all these things will also change in Germany, but it will take some time. Yeah.
Great. Thank you, Wolfgang. Thanks for the great presentation. There's a lot of helpful information. Our next webcast is scheduled for March 25th, 2024. We hope that you're all able to join us. And again, if you have an AVW International subscription and you answer the poll questions, you should see the CPE certificates within 2 weeks from today's webcast. And again, I want to thank everyone for joining us. And depending on where you are, have a good morning or afternoon or evening. And we will
Thank you,
talk to you later.
Chanda.
Thank you.
Thank you.
I'll have a great